All right, so in this video, I'm going to talk a little bit about some issues pertaining to the timing of taking Social Security retirement benefits. So basically, Social Security retirement benefits can be taken at any point after age 62. And the full retirement age for people born after a certain point, I think it was 1960, um, is 67. So there's some leeway in when people can actually choose to claim benefits, but there are all kinds of repercussions. And some of those I've discussed in some prior videos. So when trying to assess when a person should take Social Security retirement benefits, it gets interestingly complicated because there are aspects involving things like, well, if there's other income, there are reductions in the Social Security benefits that can be received. Um, if a person is still working well, if they claim early. And so then that it relates to taxation. But then there are also, if you wait, there are possibly increases in the amount of benefit, but you receive benefits for fewer years. But on the other hand, if you claim earlier, and you get decreases due to claiming early, and the early and late are relative to the full retirement age. And really kind of the list just sort of goes on and on of all these different kind of factors of, well, late if you file later than full retirement age, you get more. If you file early, you get less, but then you have to look at the reductions in income, the taxation, and all these kinds of things to try to figure out what's the best option. And basically, when you're thinking about this, what would, from at least a theoretical perspective, what makes the most sense would be to try to look at the present value of expected benefits and how those would change depending upon when the benefits are taken, and try to pick the option that has the highest present value. Um, However, that's complicated because in order to figure out the present value of expected benefits, for one thing, you'd have to know how long you're going to live. And for another, then you have to mess around with discount rates and things like that too, and figure out what's an appropriate discount rate and so forth. And at a minimum, figuring out the life expectancy is a little bit of a challenge, right? And that kind of ignores some other factors that I'm going to talk about here in a second. So the reality is that present value probably does actually of expected benefits probably does actually change depending on when the benefits are taken. It's just not always 100% clear which scenario makes the most sense for any particular individual. So um, when evaluating the factors associated with that decision, one of the factors that should be mentioned would also be the cash flow situation. So if you are in a situation in which cash flow is poor, and you're not doing real well, and from a cash flow standpoint, so you just don't, maybe you got lots of assets, but they're not very liquid, right? And so maybe big ranch or something like that. So, but lots of land, lots of property, but it's not producing a lot of cash for whatever reason, and so it's difficult to pay the bills. Well, in that case, the cash flow situation may nudge you towards trying to claim earlier because you just need an inflow of actual cash. So depending on your cash flow situation could influence when you would want to take the retirement. Also life expectancy. So the longer you expect to live, probably the later it makes sense to claim it because you have more years to recruit those higher to get those higher payouts and therefore to get a return on passing up the first few years of benefits. So it does kind of turn into sort of a cost benefit analysis, basically, of, well, if I claim early, I get more years of benefits, but a lower amount. If I claim late, I get fewer years of benefits, but I get larger amounts. So trying to figure out what the cost and benefits of those. You can do a sort of a basic break-even point. You can do a calculation where you look at the amount given up by delaying, you divide that by the amount of extra benefit per year. And so let's suppose you were going to give up $12,000 in Social Security. Let's say you're going to give up $12,000 in Social Security payments by delaying, and you're going to receive an extra $1,000 more extra benefit per year by delaying. And obviously, I'm just using round numbers here. It's not exact, but the idea would be, I would say, I take that $12,000 that I give up by delaying, divide it by the $1,000 extra that I get. Basically, what that would mean is just on a basic level, I would need 12 years of benefits to basically of that higher amount to basically recover the amount that I gave up by passing up that first year. So that's just sort of a basic break-even point. It basically means if I expect to live longer than 12 years, okay, maybe this actually makes financial sense to delay, right? Now, where that gets a little bit interesting is, that does ignore time value of money and things like that. And so you have to start looking at time value of money and possibly cost of living adjustments and, all those kinds of things a little bit to assess, more accurately. But it gives you at least a ballpark kind of an idea of, sort of what would make sense. But you also need to be thinking about, well, okay, that discussion doesn't really factor in the impact from a taxation standpoint or any of those other things either. But it does give you an interesting place to start, at least. Roughly speaking, um, what how many years would I have to receive that higher benefit amount for this to have made sense? Um, Now, it's also worth noting that there can be a sort of an overlooked aspect of working longer, and that is working longer can actually increase the base amount that is derived from the 35-year work history, because the Social Security takes the highest 35 years of working into the calculation. So if you had a couple of years in there that were not great, adding a couple of years of employment in there can actually sort of drop those out of the calculation. And now your average earnings could be significantly higher, perhaps. And then if that's the case, then that actually starts to affect the benefit amount. So that's kind of worth noting as well, that not only do you get a boost due to the percent, like a percentage boost, but you also get a boost perhaps due to the number of which years are factored into the 35 years. It depends on a unique situation that a person's facing, but it's possible. Also, if we have a married individual that is claiming prior to normal retirement age, they will have their own retirement benefit and their spousal benefit permanently reduced. So for a married individual claiming prior to normal retirement age, their own retirement benefit and their spousal benefit will be permanently reduced, basically, because they claimed early. So that's something to be thinking about. For divorced spouses born prior to January 2nd, 1954, they can actually delay receiving their own retirement benefit while collecting based upon their ex-spouse's benefit. So, and that only applies for divorced spouses born prior to January 2nd, 1954. But what they can do is basically, rely upon their ex-spouse's employment history to rely on that, and then delay their own. And by delaying their own, they can get the higher benefit amount for filing for their own later, which is kind of interesting. Okay, but that would be only for divorced spouses born prior to January 2nd, 1954. Okay, hopefully this is giving you at least a little bit of a thought about some factors that kind of relate to the timing of taking Social Security benefits. Thank you so much for watching, and have a great day.